Good morning. It is Black Friday 2018. This is the day of the year when all of the stores in America make 942% of their profits for the year. 942%. Got that? All right, we're going to talk a little bit about oil because people are freaking out. And we're going to talk about the dollar because you should freak out. And if you freak out about the dollar, then you feel better about oil. And if you're freaking about technology, you're right. We're all going back to phones with cords on them. That's what's coming. Horse and buggy's coming back too. So let's talk a little bit of something. So oil is down, getting crushed again today. Funny thing is yesterday I got a tweet from Dale Pinkert over at Forex Analytics who said one more whoosh down in oil, and then it's back up significantly over time, is what I would expect. So today we're getting that big whoosh down in oil, more margin calls, people just dumping because they want to dump, and the pretend narratives that really don't take anything fundamentally into consideration when it comes to uh, short to intermediate term oil trade. And this concept that Saudi Arabia and OPEC and Russia are going to allow the oil market to remain partially oversupplied in America, in the United States, while at the same time just absorbing the price haircut is frankly monumentally stupid. So as HFIR and several other sources, including oil price, which despite my reservations about them, I still subscribe to just because they do have a lot of content. You just got to go through it to find what's valuable. This idea that the Saudis and the Russians are going to allow oil prices to stay low overseas just shows little understanding of the oil markets by a lot of people. And because traders can chant things over and over again and retweet them and put them in their little video blogs, like this little video blog, people listen because they don't understand. They go, oh my God, oh my God, oh my God, oil's going to be down forever. No, this is a very temporary move built on a glut in America and America only because the Saudi Arabians exported a ton of extra oil to us over the summer and into the early fall because President Trump asked them to in preparation for the Iran sanctions. And then President Trump gave way more waivers than anybody expected. Now, waivers were always expected on the oil for China and India in particular. Then you'd expect a little waiver for Japan and South Korea, some of our other allies. In total, there were 8 waivers granted, and that took the market a little bit by surprise. But the reality is we knew that those waivers were coming because back in July, and I posted this recently, I believe it was Mnuchin, I forget which guy it was, said, hey, there's going to be some waivers for the countries that have shown progress in reducing Iran oil imports. About 1 million barrels per day of Iran is off the market right now. And it's probably going to go up several 100,000 more barrels a day. Yes, there's a little bit of a black market going on. But the reality is, countries don't want to screw around with us when it comes to international banking and transactions. Some enormous number, like 80% of all international trade is done in the dollar. And over time, that will come down, right? They'll come down to 70 and 60 and 50% over the next decade or two. But this idea that it's suddenly going to, that the dollar is suddenly going to be put out of business, even if the petrodollar is marginalized a bit, is just silly. And the reason that it's silly is there is not a viable alternative to the dollar. We've been through this before. The euro is not a viable alternative. Here's why. They don't have the structural integrity as a currency bloc, Brexit, or as a fiscal entity, right? See how they're fighting with Italy, in order to be a reserve currency. Now, can they be a widely used currency? Are they necessary for traveling to Europe? Yeah. Do you use the euro in international trade? Really only to the extent if you are a euro-based country and you want to balance out your foreign reserves a bit. The euro will not challenge the dollar, not today, not tomorrow, not 10 years from now. The euro might even fall apart. Italy is creating a problem right now, and if they create a problem, then there could be dominoes that go. And there's not a lot of reason for the euro to survive with the current state of the European Union and the fact that, you know, the nationalists across the world have all decided that everybody else is the problem. So when you're an American and you think the Mexicans are a problem, or you're the French and not really the French, if you're Germans and you think the French are a problem, or you are the Italians and you think the EU is the problem, right? It's always the foreigners. If something's wrong in your country, pick on the foreigners because it's their fault. Don't look in the mirror. Don't look in the mirror. It's the foreigner's fault. They're a different color. They speak a different language. They have a different religion. It must be them. Can't possibly be you. Can't be the person in the mirror. Can't be the country in the mirror because, hey, we're exceptional. So the dollar is the cleanest dirty shirt. You can go through all the major currencies. The yen. Japan has no resources and they're an ancient country from a demographic standpoint. Uh, they really don't have, and they're deeply, deeply in debt, far more than the United States. They just don't have the capacity. In fact, I still believe, like Kyle Bass, I believe that Japan is going to collapse. And they're going to go through what amounts to a massive, massive reset. I don't know if they just print trillions of yen, but I think this whole debt jubilee idea, I think it will be a competitive event. I think that there will be relative inflation across the planet, with the United States being the best off when that occurs. Other countries are just going to get whacked because their currencies are going to be so incredibly devalued. But again, it's going to be relative. If everybody's devaluing at some point in 2 or 3 or 10 years, we're going to see a reemergence of fundamental strengths. And when it comes to fundamental strengths in an economy, productive capacity, and everything else, nobody comes close to the United States, not even China and not India. So on a per capita basis, especially, nobody's close to us. China's economy is a shade bigger than the United States now, and they'll continue to grow their economy relative to ours simply because they have so many more people that still have to make their way into the middle class. In any case, the dollar next year, however, is probably going to face major, major headwinds. And there's several reasons. The first of which is that we decided to give tax breaks. Around 80% of the tax breaks went to the 1%. Those tax breaks, which amount to around $1 trillion, added to the federal deficit. So we're going to run a 1.3, 1.4, 1.5, depends on tax receipts, $1 trillion deficit in 2019 and again in 2020. In a day when we want to do infrastructure spending, how do we do that without running up the deficit even further? So in the very short term, the next year or two, the dollar's got problems. And we have to refinance, I think it's $8 trillion in the next 12 to 18 months of our debt. That's why that's the real reason why the Fed is raising interest rates. It has nothing to do with freaking inflation. It has to do with we have a bunch of debt to refinance and we got to find somebody to take it off our hands. Eventually, that game doesn't work. I think it works this time, but eventually that game doesn't work and we get helicopter money. And I'm actually going to publish, uh, very seriously, I'm going to publish an economic idea for how helicopter money would work, which would not only bail out the American retirement system, but also would bail out our federal debt. It would wipe out trillions of dollars of interest expense if we did an idea that I have that I know others have shared. Uh, but in any case, short term, the dollar is going to get weaker. It is at a peak right now. Um, that is just not going to last. And remember, I'm the guy that in 2012 wrote Strength Beyond the Balance Sheet, all the reasons why the dollar is going to be strong long term and the reserve currency. Of course, that doesn't mean that the dollar can't fluctuate. Running up our deficit during a good economy made no sense at all unless we had things that we wanted to do that could push back on that. And that's really what's going on with China is we're using the stimulus from tax cuts, which will be gone by the end of next year, um, to negotiate with China, right? Because we know that the China negotiations on trade are having a downward right effect on the economy. So the international economy more so than the United States so far, but that could change next year if there isn't an agreement at the G20, or at least an agreement to get to an agreement at the G20 next week when President Trump and President Xi get together. Interestingly, Peter Navarro has been told to stay home. He's not going to those meetings. He didn't go to those last ones either. So it looks like Navarro's being put on the back burner, and I think that's good because he's a knucklehead. But if we get a deal with China that somehow includes soybeans and natural gas, and you have to pay something for the technology that you want, I think that there's probably a good chance that this economy really rockets upward. So consider that in the face of potential China trade deal and the idea that we're going to have a falling dollar next year because of the deficit, that would probably drive oil up considerably, correct? So we have all these bullish factors lining up for oil. The falling dollar, which is very probable, a China and United States trade deal, which, let's face it, the the downside has been priced in now, correct? You have to consider positive and negative surprises, positive and negative events, and when the market is pricing in one or the other. Right now, the market is pricing in all these negatives. What if all of the negatives don't occur? And it gets repriced upwards. And that's going to happen with oil, and that's probably, I should say probably not, that's what's going to happen, but probably what's going to happen with oil, what's going to happen with technology. So going back to Iran, all the way full circle, what's another bullish item for oil that's coming? Saudi Arabia has already said they're going to cut exports to the United States by half a million barrels per day. That's more than what they increased it earlier. We know that when they cut exports to the United States the last time, price of oil went from the 40s to the 70s. The exact same thing is going to happen over the next 6 to 9 months. Price of oil is going to go from where it is now, today's whoosh down, which is the third whoosh. I didn't expect the second or the third one. So this is really way overdone. But eventually, and when I say eventually, 6 to 9 months, oil will be in that 70-ish range again. At that point, I will sell my oil and I will sit on the companies. And I have some reasons why I'm going to sit on those companies, and I will get to that in just a second. But Saudi Arabia is going to cut. There's North Sea oil that's already getting shut in, right? I had that headline up here earlier, but here you go. All they have to do is talk about a deal. They don't have to have a deal. They just have to make progress towards the deal, and get away from expanding tariffs. Trump and Xi could kill the bearish sentiment in oil. Yeah, they could. Absolutely, they could kill it. All they have to do is say, hey, we're not going to ruin the world economy. The Saudis aren't going to get fooled twice on those sanctions, right? They got what they wanted, which was sanctions on Iran, and then Trump backed off a little bit, and the market went nuts. Now, granted, people don't understand that he didn't back off much. He took credit for it, which was kind of stupid, because the Saudis didn't like that at all. I mean, multiple reports that the Saudis are incredibly pissed off. You should consider that suddenly you have people talking about how unstable Prince Mohammed bin Salman is. I will tell you, you should not put it past certain elements of United States business and in government to put massive smear campaign on the guy. Now, I'm not saying he's an angel. He just had somebody killed. There's no doubt in my mind that he had Khashoggi killed. However, he has been moving in a direction that we don't like the pace, but the reality is that Mohammed bin Salman has started to move the country, Saudi Arabia, in a direction that is totally different than what they had been doing in the past. And turning that ship is not something you do in 2 weeks or 2 years, maybe not even in 20 years. It's going to take a very long time. So while we can press on countries like Saudi Arabia to change their ways, which we should have been doing decades ago, or China to change how they do things, which how do you force China to do anything? The reality is that the natural forces of the economy and of human nature do move in certain directions. And one of those directions is libertarianism. And I'm not saying that from an ideological standpoint. I'm saying that from the standpoint of ultimately people want to do what they want to do. They want the freedom to explore their place in the world and to do the things that they want to do, make money the way they want to make money, live the way that they want to live. And to the extent that they are suppressed from doing those things, which is massively suppressed in places like China and Saudi Arabia, to the minor suppression that we have here in the United States, which we push back on nonstop, and rightfully should, because the encroachment of government, if you read my blog this week, is something that we really want to try to avoid. And I think that slowly but surely, over a generation or two, you'll see China, you'll see Saudi Arabia slowly come around to more free types of living. But at the same time, we all go through cycles. I wrote this on Wednesday. I'm thankful for the stock market correction, capitalism, and my dog. Why was I thankful for the stock market correction? Because we were able to add high quality names like Amazon and Google, and I'm actually going to buy a little bit of Apple for my retirement income accounts. I think today, if not today, then next week. And I acknowledge, sure, the stock market can still go down, but when you price things into the market, don't get caught up in what the news is today. Think about what the changes are that could occur in coming quarters. And the likelihood, and here Stansberry is starting to say what I've been saying, is there's probably a likelihood of a melt up in the market, not a melt down in the short term. And I'm starting to think that with the dollar getting a little bit weaker, and with oil going up in the short term, which will drive equities up, but then plateauing for an extended period of time because of the production increases that will come online at the end of next year, we could see, I don't put it past the people in charge to screw things up, but if they don't screw things up, we could see quite a run on this economy to the upside and the stock market as well. So we just have to be more nimble and to understand what's really going on. I know people have gotten very breathy and, oh my God, I'm down 25% and 30% and 40% on certain positions. Buffett has told you if you can't stomach a 50% swing, get the heck out of the market. You shouldn't be managing your own money if you can't handle these types of swings because they're unpredictable and they happen. Ultimately, if you scale in below the midpoints, which we've done, even if you don't get the bottom prices, which we haven't, not this time, um, things come back to you. And I have talked a lot about leverage in the past. People were asking me about buying leaps a month ago, and I said, hold off on the leaps. I'm not excited about them yet. Finally started getting into USOU about a week and a half ago. People got in too fast. Scale in, scale in, scale in. Take your damn time, and it should take a month or two or three to get scaled into most positions most of the times. And I'm going to keep telling you that, but I'm going to keep getting more irritated the more times that you screw it up. Get it into your positions slowly. If I write an article that says, hey, this is what I'm buying, that doesn't mean blow your wad. It means take a little starter position. It doesn't mean the next day, if it's down again, you buy. You look for technical levels. You look for oversolds. You look for at RSI. You look at shaken ratio. You know, slowly scale in. I've said it over and over and over again. If you've been doing that with oil, you're going to have a cost basis on USOU under 40 at this point. I do, 36.83 or 38.63, something like that. And even with this blow off, who cares? Right? Who cares? Because when oil goes from 50 to 70, that is going to be a 40% jump. And that means USOU will double. More than double. It'll get up into the 60s. So if your cost basis is in the 30s, you've doubled your money. The idea that that's not a great rate of return is silly. Now, you can't have giant positions in that, right? And I'm at like 8 or 9 or 10%. And that's because every time it goes down to the point where I've lost 20 or 30% of that position, then I add some more. I don't add to it every 5%, 20 to 30%. Big gaps. It's a leveraged position. So you have to triple, double, or triple the gaps between purchases than you would on a non-leveraged position. All right. Enough of the telling you how to trade for the umpteenth time. You have to slow down, keep your finger off the trigger buttons, set limit orders. I don't know how else to tell you without getting a little bit irritated because I've had 7, 8, 9, 10 people say, hey, I got in, I'm out of cash. Well, you didn't scale in slow enough. Over and over and over again, I tell you this. You have to keep your finger off the trigger button. You have to set limit orders. You have to have a plan. Don't do it on feeling. Don't do it on guts. Say, okay, this is a support level, that's an oversold level, and then that's a big support level. Right? The reason that we sell puts a month or two out is because it spreads out your buying. Right? The puts aren't for the income. The puts are to help you scale in. The income's nice when they expire. And you get to recycle your cash and try again. Maybe on the same positions, maybe on different positions. But you have to think of all these moving parts at once, have a plan, scale in over time. Generally, like I said, 1, 2, 3 months, not 1, 2, 3 weeks. Coming back to oil. Oh, here it is. Yeah, there was an oil field that shut down in the North Sea. If oil prices stay down for a little while, there's all sorts of wells that get capped. right? Because they're hard to operate at a profit, and so they don't. Saudi Arabians cutting exports to the United States by 500,000 barrels. Russia is probably going to take 300,000 or 400,000 barrels a day off in production. Why? Because all they have to do, they don't have to shut anything in, right? There's a normal rate of decline. All they have to do is not invest in replacing the rate of decline. That's it. And then it drifts off over 2, 3 months. Saudi Arabia just stops pumping it when they want to stop pumping it. I'll bet that Saudi Arabia cuts their oil production by at least 600,000 to 700,000 barrels a day. So not only will they cut their exports to us, they're going to cut it to the rest of the world probably by about half as much as they cut it to us. I mean, we're the important market. Here's why. And this is something that I put into the middle of the program because I'm hoping that some people left after that last rant, which doesn't look like happened. Refineries in the United States can't operate without some of that medium crude from Saudi Arabia. So when they cut that, we've got a problem. Because we don't have the capacity to just run on the light sweet that we produce. So when Canadian oil doesn't get here because of the lack of pipelines, when the Saudi Arabian oil doesn't get here because they decide not to sell it to us, that drives the price of our oil up. There's going to be no new Canadian oil pipelines in operation until the end of 2019. The only one that I see that'll come on by then is the one in Minnesota that Enbridge is going to build, and they still don't have their water permits. So flip a coin on whether they really get done by the end of 2019. When you take into consideration the fact that the United States is back up to the 5-year average for oil inventory, and then you look around at the rest of the world, and you see that really nobody else has extra inventory. And that's true. There's very little oil inventory around the world. What is keeping global oil prices down is strictly the average inventory in the United States. That is going to come down dramatically starting by the end of December and into January because of the lack of imports that because we're going to see the cut in imports. So even though OPEC or ROPEC, Russia, OPEC, ROPEC, is probably going to cut their oil production by, they're saying 1.3, 1.4 million barrels a day. I'm going to go out and say it ends up being 1.6, 1.7, 1.8 million barrels a day because they want to shock the market. So they started saying 1, and then they said 1.3. It's going to end up being 1.6, 1.7, 1.8 million barrels a day that they're going to cut by. Might take them 2 or 3 months to get there, right? Because Russia's oil fades off, and OPEC's oil they can turn off and on like a faucet. But Russia's going to take 2 or 3 months to get their 300,000 or 400,000 barrels out of the market because they'll just not drill a couple of wells, and as the other ones decline a bit, that's where their cuts will come from. And they like that because as the price of oil goes up to 70 and they've cut their capex, now all of a sudden they still have similar production at higher prices and without the expenses. Right? Great equation for them. There's an article earlier this year about the new refineries in America that are coming, and it's really no new refineries. They're just expanding some capacity. We are going to add a little bit of light sweet crude. Remember, we use about 18 million barrels of oil a day. And up in North Dakota, they're going to add light sweet capacity of 49,500 barrels per day. Let's think about these numbers. Saudi Arabia is cutting exports to the United States by probably 500,000 barrels per day. Right? We're going to be getting almost nothing from them. And our response is to add 50,000 barrels a day. That's 1/10. Right? These guys will add 26,000 barrels a day. We don't have any large refinery projects. There's no brand new refineries. These are all just expansions. The current refineries, or these are little plant conversions, right? Plant conversions. So we still have a problem for the foreseeable future on oil, even if we produce a lot more, right? Let's say by the end of next year, we're at 13 million barrels a day of production, which a couple of years ago, I would have thought we'd get past 12, but it looks like we're going to, by the end of 2019, we'll be at 13,000 barrels a day. That's not going to offset what Saudi Arabia and Russia are doing, and it's not going to offset total new demand, which, if the economy is good, will exceed the IEA estimate of 1.3 million barrels a day, right? Which had been lowered from 1.6 to 1.4 to 1.3 because everybody's banking on a slower economy next year. Let me ask the question again. If we're already pricing in a slower economy and an oil glut, what happens if the economy doesn't slow down as much as people think, and we really don't have the oil glut? And P.S., we pretty much know that we don't have an oil glut, right? They're not going to fool the Saudi Arabians twice. The Saudi Arabians can't afford for oil to be in the 50s. Has to push 80 for them. So in order for them to get the Brent crude price up, they have to get the WTI price up as well. Easy. Cut exports to America, because our light sweet crude, even if we had 20 million barrels a day, wouldn't be enough for us because we can't refine it. We have to export it. And there's limited markets for light sweet crude at this point because the refineries around the world are mixed use. There's some medium, crude out there, refineries. There's a lot of heavy sour, and then you have light sweet out there as well. But you're starting to run up to the point where this new supply of oil doesn't coincide with the refineries. And improving those refineries changing those refineries is very, very expensive. So you should expect the price of oil once again to go back up into the 70s on WTI and into the 80s on Brent. For us, it's important to realize that the spread between Permian oil and WTI is going to narrow dramatically as the pipelines start coming on in Q3 and 4. Early Q3, maybe late Q3, or Q2, one comes on, a little one. But by the end of next year, you're going to have the spread between WTI oil and Permian oil, West Texas versus Permian specifically, narrow a lot. And we want to be in those Permian companies, one, because it's the cheapest oil. Invest in the cheapest oil because they will capture the most profits. Two, there's a spread right now for those Permian oil stocks because everybody's talking about, they don't have takeaway. The 4 companies we are in do, and one of the companies even has their own refining. So when you take a look at where you want to be invested in oil, it's those 4 Permian companies, and then Continental Resources because they're unhedged. In a rising oil price world, Continental will do very well. I think this is my last time in Continental because once I should have sold it in September. I should have sold more of it in September. I trimmed across the board, which I told everybody to do, to trim. And trim doesn't mean pick and choose. I'm going to sell this one but keep this one. No. Sell a little bit of everything. Don't try to be that smart. Just proportionally sell things. I'm going to sell 30% of this, 30% of this, 20% of that, 40% of this, 30% of that, half of that. That's how you sell. That's how you trim. Take off a quarter position. Take off a half a position. Take off a third of position. But don't say, I'm going to sell this one and keep that one. Why? because you get emotional about it. Well, this one's won the most, so I'm going to keep it. This one lost, so I'm going to sell it. Or the vice versa. People do it the opposite way too. Trim proportionally across the board. Here's a trade for you. I'm not going to do this trade because I just don't have the cash for it right now. But if you were a swing trader, you'd be looking at these refineries. These refineries are going to probably have very good numbers when their next earnings come out, and they're down around technical support levels, right? Right? So Marathon, Valero, and Valero could go a little lower. Phillips 66, right? When did I say that the run in refiners was done? I started saying it around February, March, April, right? Got that final tip, and then bam. They're probably going to rebound a little bit back up to resistance levels, but as the price of oil goes up, they'll probably turn back down, right? Because refiners don't do well in a rising oil price environment. They do better when oil prices are stable or falling. In addition, they have the problem that there's enough light sweet here for them, but there's not enough medium and heavy sour because our heavy sour partner, Canada, is having a hard time getting any more to us, and Saudi Arabians are going to cut their medium crude to us. Those are the dynamics of the oil market. You need to understand those dynamics. If you don't, right, you can get in trouble, especially if you scale in too fast, which unfortunately I know some people did. So mind your asset allocation, scale in slowly. When you trim proportionally across the board. When you buy the highest quality. That's what we want to do. In general, stock market, what did I say would happen? When I gave my forecast last year, the futility of forecasts and my forecast for 2018. I said the stock market would fall down to around 2,500 by the end of the year. And we're essentially there. Hmm. 600? Trying to find. I pointed it out last week, right? Talked about the corrections. Got that February one right. Got the October one right. So think about this. We got both corrections right, yet there's still people underwater. That's a trading problem. All right. Here it was. Ultimately, I see earnings disappointments towards the end of 2018. Right? They lowered their forecasts for 2019. I think that's lowered the bar, and unless we ruin the economy, they should probably get over it. I think that the fourth quarter, I think Christmas shopping season, I think these are going to be blowout numbers. I'd be pretty surprised with consumer confidence this high if retail doesn't do well. If retail doesn't do well, I'll be shocked. But I bet there's a record. What do they call that thing for Amazon on Monday? Whatever that it's called. I think that's going to be a record day. And given what I saw driving home last night after seeing Bohemian Rhapsody, hence why I opened with Queen today, I'm curious to see what the numbers are. So, okay. If we're flirting with 2,500 right now on the S&P 500, right? What are we at? We are at 26.30, right? So that's down from the very start of the year by a couple points. Will we get all the way to 2,500? I don't know. These numbers don't mean a lot. But I was trying to talk about the general direction of the market before we got back in the rally mode. I do think that we get this big buyback and rally starting soon because I don't think all the negatives are going to manifest. If we get all the negatives from the government or from the Fed, then maybe we don't get quite as big a rally. But again, we've priced in an awful lot of negatives. The stock market is basically flat now for an extended period of time, right? What happens whenever the stock market is flat for an extended period of time? Generally get a rally. And you generally especially get a rally when the price of oil goes up. So take a look. Market's gone nowhere in a year. So take a look at a longer period. Happened here. Zoom. Happened here. Zoom. How far do you want to go back? You can find periods where the stock market, let's go back to the early 1990s. Sideways market, up. Sideways market, up. Sideways market with a dip, which would mean buy, up. Then you get the tech wreck. That's a real event. And then you have stall up, stall up, stall up, stall up. Then you have the financial crisis, off a cliff, rebound, side to side here for a year, up, side to side here for a year, up, side to side here, not quite a year, here, here. Now, I do believe we get to this level for sure eventually. Is it this time? If it is, right, if the negatives are correct and we really do slow down the economy and we get down to here this time, all you can do is hold your nose and wait. Unfortunately, sometimes that's all you can do is wait. The good news is when you wait, good things happen. Now, what if we completely blow up the economy? We bring it all the way back down to this level, right? Because this will be support. I mean, these were resistance, broke through the resistance. So could the stock market come back down to here? Sure. It would take a major, major event. What is that major event? European economy is already slow. How much worse is it going to get? Japan's been plugging along for 20 years, 30 years, right? They didn't need to actually collapse. China, they have two buckets of money. They have the federal money, which is surplus, and they have the local money, which is deficit, right? Because they have all those companies and municipalities that are struggling. But the feds have a ton of money. Do you really think the Chinese can't go out and borrow if they needed to as well? So they not only have cash they can spend, but presumably some sort of a line of credit. If they start buying oil, even partially in yuan, which I think is coming, that also weakens the dollar, by the way, which would drive the price of oil up in dollar terms, and especially in America. But then the Chinese become a more internationalized currency, and at a minimum, they can start expanding slowly how much nations use the yuan. So all these things are coming together over the next several years, next couple of decades. The Chinese yuan will be used more internationally. Under the Communist Party, it'll never become a reserve currency. For the yuan to be a real reserve currency and not just a widely used currency, um, they would have to succumb to an actual rule of law and more open democracy. Does anybody see that happening in the next generation? I sure don't. Maybe 2 generations from now or 3 generations from now. Maybe by the end of the century. It's not going to happen soon. If the euro survives, and I think that it will in one form or another, again, we've talked about this. Not reserve currency sort of currency. You need to travel in Europe, right, to see the sites and do a little bit of trade with them, right? Because some people will demand euros, and some nations will demand euros, but you're really just not going to see them. So again, the dollar does remain the reserve currency a long time, but that doesn't mean it can't weaken cyclically. And we're about to come up on a cyclical weakness in the dollar. So all these things, and I've repeated myself 2 or 3 times now, can drive oil higher. This is just a trading cycle. We did okay with it. Could have been better. But again, margin of safety investing and fundamental trends are primarily position trades. So sometimes the swings don't go with you in the short term. Hence, again, scale in slowly. What do I think for oil? Outside forecast, next 6 to 9 months, we'll get back to the 70s. I really don't have much doubt in my mind. And even after all the oil comes online in the Permian in the second half of next year, that'll be good for the Permian companies, and it'll put oil on more of a plateau. So the Saudis want that plateau to be in the 70s on WTI and 80s for Brent, and they need to get it there before the Permian oil comes online, because otherwise they'll just get these narratives again. Probably by March, April, May, maybe June or July, but sometime in between March and July, I won't own oil anymore. I'll own oil stocks, but I won't own oil. So keep that in mind. At some point, you're going to want to take your profits and be done with it. For those of you with options on oil ETFs, you have some potential explosive upside. So keep an eye on that, because that's where the leverage probably works even better than these leveraged ETFs, which, on down days, they just get destroyed. So look at what you want your portfolio to be, short term and intermediate term. And when you sell the oil, you should be looking at reallocating that money. Whether you hold it in cash a while or not, it's up to you. But reallocating that money to what you want to own long term. And as I said in the blog on Wednesday, what I'm thankful for, if you haven't built a good stake in Google and Amazon and own some QQQ at this point, you ought to quit handling your own money. And I mean that. Apple too. If you're a dividend investor, you should be buying Apple. Buffett is. Warren Buffett's buying Apple right now. Guarantee it. I guarantee it. You can call him right now on the phone. Should you call him on the phone right now? Somebody give me his number. All right. I'm going to do some questions here. And I've made a vow that I'm going to keep these calls to 1 hour now. So we have 10 minutes. Do you recommend adding more USOU? Well, again, I don't know what you own. So that's a big deal. Oops, that one. But in general, If you don't own any USO or USOU, right? And here's the thing. If you don't speak technical, if you don't speak quant, never use a leveraged ETF. We've been through this before, which is why I'm separating the swing trading into a separate service. And you won't be allowed into that service if you don't know a little technical trading, a little bit of quantitative trading. Because this whole gutting it out thing is killing people. RSI, look where RSI is, right? If you're not using leverage, you've built a great position. If you are using leverage and you bought in too quick, you're getting your butt kicked. You're probably down 30, 40, 50%. Let's just look at USO without the leverage, right? Look at that. Stopped going down, started going sideways. This screams by USO. And what are the similar? Let's see here. I have a few subscriptions. Right. So USO, if you can buy calls, I would buy calls on USO before I buy USOU. Although tomorrow USOU probably rallies. So if you want a very short-term swing trades and day trades on that, that's on you to know how to do that. Go ahead. Calls on USO and on DBO. And DBO, almost everybody has that too, available to them. I think calls on DBO and USO are probably the way to go. If you want to use the leveraged ETFs, have at it. UWT, Oil U, and USOU used to have a lot more assets. I'm not really sure why they don't, but you know, USOU and UCO, you know, those of all Oil U have all surpassed them somehow. So we might have to start using something else when we want to use leverage because that has really changed a lot, which is interesting. But all right, moving on. CTL ex dividend today. Yep, great. Perk, what's the risk that crash 2020 begins before oil rebounds as you are predicting? I don't know. Right? I don't know. We've talked about what's priced into the market right now. Now, do those things come true? Does the economy really slow down a lot next year, or just a few tenths of a percentage point? Right? Do Trump and Xi cut a deal? Does the Fed, stop tapping the brakes so hard? Those are the things you need to watch. Just talked about the dollar and the price of oil. Where is CHK with their oil hedges? I don't know. Check. All right. You've mentioned First Solar a lot in the past couple weeks, but not so much Solar Edge and SunPower recently. Any reason you seem to be favoring First Solar? Yes, there's a few reasons. First of all, incredibly strong balance sheet. Second, SunPower has really dropped out of the utility scale segment. And we have a SunPower position for commercial and for residential. Tesla overlaps on residential and microgrids. First Solar is really the only game in town for utility scale at this point. I mean, some obnoxious percentage of the market they have, and they have a great balance sheet. Utility scale solar is going to be necessary for cities, right? Because how are you going to get solar energy on top of some of the buildings that are out there right now? And new constructions are going to probably come with solar. They actually are starting to already in Wisconsin. I just drove through with my girlfriend a net zero carbon emission community where they all have solar, and they're not even doing it well as far as I can tell. But they're doing it, and I think that First Solar is going to see massive, massive demand over the next 15 to 20 years, starting now to 2 years from now. I mean, it'll be in the next few years, and the market will anticipate that, um, soon. But solar energy is here, and it's growing rapidly. And utility scale is a big deal for the cities because you can't expect the people to all go start retrofitting their houses. The utilities are going to start getting loan guarantees from the government at some point, and that's all it'll take, and they'll start building these out because building a solar power plant at this point is cheaper than building a coal power plant. We already have enough base energy to get us through the night. The variable energy, which is during the day, right? People are working during the day. That's when energy uses up during the day. Well, solar works just fine during the day. So I would expect that the trend of the last few years, which is that all new power generation comes from alternatives, and wind's been in the lead, but that's going to flip, and solar is going to take the lead. Wind was just ahead of solar. Solar is going to jump ahead of wind, and then really start to open up ground. Again, this comes down to technology issues. I think First Solar is going to make a mint, and I think for sure they're a buyout candidate, right? If General Electric is smart, and I don't know if they are, because I don't know why they just don't put the freaking dividend to zero. They would sell damn near everything that they own. They'd spin off the healthcare into general healthcare, and they would spin off aviation into general aviation, and then General Electric would become electric again, and they would work on smart grid and alternative energy, and that's what they should do. And they should sell off their stake in um, Baker Hughes, which they said they're going to do, and GE could make a roaring comeback. But the problem with GE is that they may not get to do that without going through bankruptcy first. They've just secured $41 billion of credit line from major banks. So it seems like they're going to bail them out without a bankruptcy and just get them beholden, which is why I don't so much like GE. I think that's not going to go away. And I think they're going to try to keep that company together, and they shouldn't. They should break it into, General Electric should be the only piece left of all of that. The electric, the energy, the power, right? Part of the power is going to die. That's just the way that goes. But they should be selling off damn near everything. That company shouldn't exist in its present form. The last time I said that, right, was about GameStop. What did GameStop just do? They just sold off Spring Mobile like I told them to in the article that I wrote and in the letters that I sent them. They don't really communicate with me, but I mean, I'm pretty sure they've read my letters. So we'll see if the next thing that GameStop does is announce changing of how they do stores to make them experience-based destination stores. We'll see. Anyway, why aren't AT&T and CenturyLink performing better? I just don't understand those types of questions. I really don't understand those types of questions. Those are, they say there's no such thing as a bad question, and I've had several today. Start reading the freaking material on the companies. Don't ask why the market's gone one direction or the other. Here's the answer why the market moves in one direction or the other. Because people are emotional and they don't do the work. That's it. That's your answer every single time. People are emotional and they don't do the work. And once you accept that, you'll start to be less emotional and you'll start doing more work. But don't expect the vast majority of investors to be unemotional, and don't expect the vast majority of investors to do the work. Hence, why so many are attracted to passive investing. It's not because it's a great way to invest. You're taking 100% of the risk of the market without any additional upside. At least when we take 100% of the risk of the market, which is infrequent, but we're doing it now, we have a lot more upside. So when this market goes up 10 to 20%, how much will we make? We'll make 30, 40, 50%. We might even double our money. Do more work, be less emotional. The market moves because of the opposite. People do no work or less work, and they're more emotional. That's why AT&T and CenturyLink aren't performing better now. Does the sun actually shine in Wisconsin? Well, when I bent, no dirty jokes. Yes, we have plenty of sunshine in Wisconsin. This is not Seattle. All right, apparently I'm being cued to that I'm at 1 hour. Oh, but Avi's right about that. I mean, Avi's a good analyst. I wouldn't call him great because I think that if you don't take into account fundamentals, you're just guessing on based on charts. And I know enough about technical analysis, having done it for 2.5 decades, to know that quantitative analysis blows it away. Write me a simple algorithm, and you don't ever have to show me a chart. You really don't. Simple algorithm. You never have to show me a chart. So I keep showing you the money flows. The money flow is the most important, in my opinion, component of quantitative analysis, and it's what underlies every freaking chart. When you take a look at, put in a stock, right? When you take a look at money flow, it tells you everything you need to know about a stock. Money flow starts to turn over, stock comes down. Money flow starts to go up, stock goes up. This is just a function, right? This is the sentiment here. This is just a function of. Am you ringing? I'm ringing. One of my poker buddies. It's just a function of sentiment. So when he writes those sentiment speaks articles, it really is a function of money flow. Here's the thing. By knowing the fundamentals, you can know whether these types of declines in money flow are likely to persist. Pretty simple. So you can have an expectation. So you can buy a little. You can write a put. You can add to your position. Right? So right here, look. And then the price came down because money flow came down. Money flow goes up, and the price starts to go up. Money flow starts to come down, right? Peak starts to come down. Price, bam. See, the money flow led it every time. Simple algorithms tell you this, and they're simple algorithms are you don't need like 25 factors. These guys out there say, "Oh, we have a 36 factor based algorithm that gets the market right in 93% of the time." All you need to know is money flow, oversold. Right? I mean, the stuff I have on this chart, the reason I show you these factors, right? Then is volume high or low, right? Volume's low. is why. So one thing I'm going to tell you about both services. Both services, the basic services, the position trading services, fundamental trends and margin of safety, we're going to add more of a component. You know, the fourth leg of the core four investing process has been quantitative slash technical analysis. I call it technical really just because that's what people, know. But the reality is that it's quant analysis is what I'm using. I've showed you one of the websites that I use a number of times. And I'm starting to program my own Python now. We're going to add a lot more quantitative analysis, not because what we've doing isn't adequate, but I really want to maximize the gains and minimize the risks. And now that we've been through a couple of corrections together, and we hit it out of the park last time. This time, not so much. We'll muddle through and we'll catch the next rebound. But the threshold for people's pain is not 50%, and I wouldn't presume it to be. But those 20 to 30% swings, that's pretty normal. And I'm okay with it because I know how it turns out. But folks are emotionally tied to their money, and the reason being because you earned it, you worked hard to get that money, and you don't want to see it lost. So we're going to incorporate a little bit more quantitative analysis in the future. And I'll demonstrate it to you using this chart really. But we're going to have to do that. And I can't stress to you enough that you really have to look at these things. This is why I've been showing you these things for over a year. You have to make this part of your decision-making process. Is this at the point where I'm willing to risk my hard-earned money? And that's the question you should ask. All right. I'm still a buyer if I have cash of pretty much all this stuff. Everything we've been buying for the last 3 weeks, I'm still a buyer. I don't have any big worries. I think that the bad news has been priced in. If we see ETF outflows, if we see people start to sell their S&P 500 funds, their QQQ, and their Vanguard funds, then we've got a bigger problem, right? But I know that Vanguard is telling people the exact same thing today that they were last time there was a correction, and the next time there will be a correction is if you got money, add. And in general, over a long enough time frame, they are always right. And I know that a year or two sometimes is like, oh my God, a year or two. But on individual positions, a year or two is not that big of a deal. But I do know that you don't want to lose an entire year or two to make your money back if you take a 20 to 30% haircut. So we're going to add some more quantitative analysis. And I'm going to add some firmer rules that I think you should apply. Rules that will mitigate your risk quite a bit. And if you really want to swing for the fences, at least we'll give you some guidelines on how to do it. I'm actually adding something that I'm taking from another contributor at Seeking Alpha. I subscribe to Nail Tech Earnings. It's the only other service I subscribe to. I've tried 50 of them. And Nail Tech Earnings, he's got a very limited stock universe of tech stocks, but he covers them very well. And basically, I use him to double check my work. So, he's got a criteria where if he doesn't think a stock can rise 45% in the next 12 months, or if he thinks there's going to be negative earning surprises, he won't be a part of it. And the negative earning surprises I've done informally, but we need to formalize that, I think, because I think people need rules. I think they like rules. I think you like rules. So we'll put some of those things in some sort of a quick list on things to do before you buy a stock. And we're going to put into the VSL, into the sheets, not until they have it within Seeking Alpha. Seeking Alpha is going to allow us to embed the Google Sheets soon. And as soon as they allow that, that's what I'm going to do because I don't like it. I like our Google Sheets out there the way they are. I know people steal the URL. So I do want that behind the firewall. And once it's behind the firewall, we're going to add 12 to 24 month targets, as well as 2 to 4 year targets, and then 5+ year potentials. So we're going to add a series of price targets, and really the 5 year potential won't even be a column. It's just the idea that in that 5 to 10 year range, we won't own anything that we don't think can triple. In that 2 to 4 year range, we won't own anything that we don't think can go up by double. And in that 1 to 2 year range, we won't own anything that we don't think can go up 50%. When you look at it like that, and there's always companies that fit in those parameters, when you look at it like that, that really slows you down on buying, right? Because you're like, okay, can my total return on CenturyLink be 50% over the next 1 to 2 years? Well, so far we've made 20 to 30%, depending on where you bought in when you figure the dividend plus the appreciation. So we're probably going to get a shot at making that 50% by the end of, by a year from now or 18 months from now. Can it double over the next 1 to 3 years? Because like I said, we're already a year into the trade. Yeah, I think it can get well into the 30s, like I said. Can it triple in that 5 to 10 year range? Yeah, I think it can, because I think 5G is that big a deal. You can apply that to AT&T and Verizon as well. And then each company has slightly different approach, so that's interesting too. CenturyLink is a potential takeout candidate. You go through all those variables and you apply. Can the total return in the next 1 to 2 years be 50%? That's going to be a new rule that we adhere to. Can it double in 2 to 4 years? That's going to be a rule that we adhere to. Can it triple in that 5 to 10 year range? That'll be a rule that we adhere to. And by the application of these rules, we'll narrow down our universe, we'll slow down our trading, and we'll give ourselves, for those of you who are going to learn a little quant and get better at technical analysis by understanding the quant that underlies it, if you guys want to come over to the swing trading service in end of December and January, that's fine. I'll give you a deal. But to be part of the swing trading service that's coming, you can't just want to, color between the lines. You've got to understand what the lines mean. All right. Any other questions? What happens to FT? What does that mean? If moving to SA, what happens to FT? I don't know what you're asking me. Nitschke. I'm not moving anything to SA. What do you mean about fundamental trends? Fundamental trends is getting the swing trading service. There's going to be 3 different services on fundamental trends. One's just going to be ETFs and asset allocation and 401k. So the base level at fundamental trends will be asset allocation, ETF portfolios, and 401k asset allocation. I'll be doing some free stuff. 401 Kirk is going to be free, but without alerts, right? So I'll just put up a quarterly asset allocation over at 401 Kirk for 401k plans, and it'll be several 401k plans. It'll be the Fidelity, the Vanguard, and the TSP for government employees. It'll be behind a paywall, I guess. It'll be behind a wall, but all you have to do is register your email address, and you can get that for free. The alerts, when to make a trade, will be through fundamental trends in that base level ETF service. The second service, which already exists, is all of the position trading. And then the service on top of that is if you want to swing trade, there'll be another service on top of that. So Fundamental Trends is the flagship website. Margin of Safety will incorporate the position trading, right? And the ETF portfolios, though I'm not going to do 401k stuff there. It's just too much to do, I guess, for the price and for the haircut. But Yeah, so nothing's happening to fundamental trends other than it's getting much, much better. I'm working with the Indians and with a guy in Atlanta, and we finally settled on a format which took a month longer than it should have because apparently when I told them what I wanted, they tried something else. Then I told them what I wanted, and they tried something else. And I finally said, "Look, copy this one, do it this way." And now they're copying it and doing it the way I want them to do it. Um, you said wait for contango before buying oil. Wait for contango? No, we want to be moving away from contango, right? So we're trying to pick a the last couple of weeks we've been trying to pick a bottom point in the contango because we want it to go into backwardation. If you don't understand backwardation and contango and which one's good for you and which one's bad, you should not be making that trade. Contango is bad for the oil for us. We want backwardation. So it's in contango now, which I said would be temporary, and it should come out as contango and go back into backwardation. And that's what we're anticipating. Uh, yeah, you know, you guys can, you don't have to listen to the rest of this, but that article that I'm thankful for the stock market correction, capitalism, and my dog, the dog part's self-explanatory. Dogs kick ass. And the stock market part is self-explanatory. I got a chance to buy some high-quality stuff, Google, Amazon, for cheap. And then the defensive capitalism that I really gave. I really know a guy through a cousin of mine, and I actually coached him in baseball freaking 15 years ago um, when he was trying to be a pitcher, and he wasn't very good at that either. But you know, he really doesn't understand the economy. He's 32. He lives in his parents' house. You know, he told me that he learned teamwork by working in fast food, and he's a college grad. He worked for Al Jazeera, and the kid's just he's an idealist, I think, at some level, and I applaud him for that. But he doesn't understand finances or the economy or why the world is getting richer, um, because he chooses not to understand. He is somehow romanticizing socialism in a way that just doesn't make any sense because all the countries that have done well are capitalist at their heart. Now, they may have different regulatory structures, they may have better or worse social safety nets, and they may or may not be making a whole bunch of money because they or have a whole bunch of money because they were an empire or because they have natural resources. But a lot of the things, and the reason we argued is because he didn't like the idea who some of my clients are. And I said, this company or that company or another company or these people, person in New York, person in LA, person in the middle of the country, everybody, regardless of whether they lean left or right, wants the same end game, right? So you have to figure out how to get there, and he just didn't understand that. He's basically, well, if you're on that side, you're wrong, or if you're on this side, you're wrong. And you're only right if you're over there on that side. And he made statements about dead white guys and old dead white guys who we need a new paradigm. Look, the world's been getting better for a very, very long time now, 30, 40 years. You can follow every statistic out there, and I've actually posted some of it in an article a while back, and maybe I'll do it again. Poverty rates are down. War is down. Almost every statistic, hunger, poverty, health, almost everything is moving in a positive direction, although you get the hiccups. And we get to see those on TV from breathless, breathy, funny faced, smirking, self righteous, know it all talking heads that they just don't get it. You know who you want to follow on TV? I'm telling you, Erin Burnett over on CNN, she's way smarter than some of those other guys. And she's humble. And she's been all over the world. She's worked for CNBC. She understands business and economics. She went to CNN because she wanted to take a greater world view. I'm telling you, Erin Burnett, of all the anchors